All right. So we are here right now with Martin Charney from Magical Mortgages. Martin specializes as well as a great mortgage broker we worked with in the past. He also works with rent to own. So today we're going to speak about creative financing, rent to own, getting into the market, why that's maybe important. And Martin's going to speak more about the financing part of it, financing challenging deals, creative financing, and some things that you can do if you're a buyer, maybe discouraged by the market or getting into it and understanding rent to own. So take it away, Martin, and let people know about you.
Okay, so I've been in the mortgage industry for many years, and I started my career with challenged buyers, and in a way, I'm still in that specialization. In other words, people that cannot just walk into a bank, people that cannot get a mortgage without some form of additional assistance. People come to me for rent to own, they come to me for co-ownership, which I'll get into the details of those two programs. But my first love and my first preference is always to try my best to get somebody their own mortgage, for them to fly on their own steam from the beginning. And basically, we look at three primary things. Number one is the gross annual combined income. So you take a husband and wife, whether they're married or community of property in common law, let's say they're earning 100,000 a year gross. So you multiply that by a magical factor of 4.5, which is pretty accurate. And that will give 450,000 will be the amount of mortgage that they can qualify for. So they might have 5% down. So let's take a price of, I don't know, 500,000. They've got 25,000 bucks, which is 5% of the purchase price. So we have lenders that will give 3% cash back, 3% of the insured mortgage amount. So normally you've got a price of 500,000. You can get a mortgage of about 485,000. So 3% of that is $14,000, which is the cash back. So the cash back is given to the borrower by these particular lenders, and it's non-refundable. So the borrower comes with an extra 14,000, which they can use for two different things. They can use the non-refundable cash back for closing costs, which is normally like 1.5% of the price, except if you're in Toronto, then it's double. Or they can use the non-refundable cash back towards any debts. So they've got credit card debts, they've got line of credit, they've got whatever they have in except for a car loan, which normally you have to pay off a car loan completely. It's all or nothing. But they could have student debts, whatever. So I would normally advise them on what kind of debts to pay off. But what I'm really trying to say is there's a lot of tenants out there. There's a lot of people that are renting, and they're paying a fortune of, like, how much are they paying? 1,800 to 3,000 a month. And they're busy paying the landlord's mortgage and they don't realize that they can become owners with their 5% and their income of, let's say they've got $120,000 combined. As long as both their credit scores are at least 680, maybe 670, they can get the cash back, and they can get the rate at as good as any lender, any one of the big banks. Now, we don't like the big banks. Most mortgage agents, brokers do not like the big banks. Why? Because the banks are screwing the public. What does that mean? That means that the banks charge a massive penalty. If the borrower wants to cancel their mortgage during the currency, the banks will charge between $10 and $15,000, and they don't disclose this in writing clearly at the time. So we try to stay away from the big banks. We have lenders that will not only do the cash back, but they will allow for an early penalty cancellation to a maximum of 3 months interest only, which is not a train smash, not a big amount.
That seems like a variable. I remember the stat too, like about 70% of people cancel their mortgage before 3 years.
Yeah, exactly.
So there's a lot on terms as well.
And it's terrible. The banks are making a fortune just on the penalties.
So if someone, so this can help someone pay down debt to actually qualify if they have reasonable credit. And if they don't have a huge down payment, they can use this as a tool. What would be some reasons that some other mortgage brokers may not be offering this? Or if someone says every mortgage broker can do this, what do you say to that? Do you figure out these relationships with lenders? Tell me how that works a little bit.
I'm always happy to help a competing colleague, professional mortgage agent, but we have been in this game for 30 years. My broker, Scott Lindsay, has been an ex-banker, and there's nothing much he doesn't know, because there's a lot of complications, like somebody can be receiving a pension, CPP pension or Sun Life disability pension. So those amounts can be grossed up. In other words, if the buyer tells us she's earning 14 net, but it's not taxable, so you can gross those figures up. There's a lot to learn. I went through a major learning curve in the last decade or whatever, since I've been in this business. And it's not just so easy to listen to one video and know, because each person is different. There's no such thing as the same kind of buyer, because they've either got some reason to wait, they've got an inheritance coming, or they've got a consumer proposal that they've just got out of, or they have got a personal guarantor, or they just got separated and they don't have a separation agreement yet. And people come to me, I'm not a divorce lawyer, so I cannot provide them with a separation agreement. They have got to ask the questions, and sometimes they're just not earning enough. It's a simple case where not every single person can buy.
And to your point as well, we do have a webinar with a real estate lawyer, Rabbit Law, and as well, we've done it too with other people. Your son's a lawyer as well. Great lawyer. So there are information on, if someone's doing that, they can reach out about that too. But you were saying as well?
I'm saying that in order for us to really know what's happening, we have to have an application from the buyer showing us his SIN number and his job letters and his pay stubs and has he paid tax. Now there's a lot of people, retailers, plumbers, electricians, striptease ladies that they don't declare all their tax, and everybody knows that. But if they don't at least put it into their bank statement, where that's called stated income, then they don't have a proof, what's it called, some sort of proof of a paper trail, it's called. And lenders will accept bank statements, paper trails, to prove that they've earned this money from which they can pay the mortgage. But if they haven't declared the tax, neither have they put it through their bank statement, then it's just about impossible, unless they've got a big deposit of at least 20% to 30% down, because there are lenders out there that will look just at the equity and not only at their income. But there's a lot of variables that we have to look at, and please believe me, it's not me that's nosy and asking all these questions. These questions have to be put into electronic form. It's a software called Filogic, and it's through Filogic that we submit these applications to the lenders. And my application, which I've worked on for many years, making changes and improvements, includes 95% of all the questions that we need. So if somebody's in a hurry and they want to have an approval next week, if they give me a fully filled out application form with a list of things that the lenders require, it can be very quick. Now, there's a big moral compass on should a mortgage agent be allowed to advise the buyer to make a clean, unconditional offer, not subject to finance. Now, obviously, the realtor will always prefer a clean deal, especially if there's a nice, juicy deposit of maybe 10% down. Then, all right, the realtors, I understand, do not earn their commission until and unless closing occurs. But I am very afraid, like my own child. Can I say to them, sure, you can make a clean offer, and don't worry about it. We'll find the money within a month or 6-week closing. But I only make those decisions if I'm very comfortable with their income having been declared. They've got enough money, and they may even have a little bit extra in case there's an undervaluation, or in case whatever problem arises, because nobody wants to put a buyer in a position that they made a clean, unconditional offer. Not only are they going to lose their down payment, their deposit, but they're going to potentially open themselves up for damages. So, agents will say, all right, I don't think it's the case anymore because there've been 4 quite major interest rate increases, but there's not that many bidding wars at over $750,000 price. And under $750,000, there's still a very strong demand for houses. But irrespective of the price, it can be a little house for 300 or it can be for 3 million. I'm very cautious when I advise people to make clean offers.
So, and to your point too, I think that's a good point as far as having your realtor do the market analysis beforehand, sending the MLS, the full MLS to your mortgage broker, right, to make sure that the property and the person is approved. We had an example of an offer that we almost put on, and it was a commercial property, and it would have affected the taxes and all this sort of stuff. So it was very important that we sent that to them. And to your message as well, doing your pre-approval and getting those questions answered beforehand, because that's going to allow the lenders to know what they can do for your file. So if you're working with someone that's either getting into the market, having challenges with saving for a down payment, they're just not quite able to save the market, and they're in that competitive range, what advice would you give them as far as creative financing or options to give them hope and trust that they can actually get into the market for these people?
Okay, so if their income is not sufficient, they could be lucky to have a granny, a parent, a relative that will sign with them and come on title. That may not always be the case, in which case they may be able to borrow some money. We've even suggested that people sell their car, because they could have a car where there's $20,000 owing on a car loan, and they buy the car back, because once they become property owners, they'll be a lot stronger and very easy to buy, even get finance on a second-hand car. So the government puts ratios, GDS and TDS ratios, and if those ratios are out, if they're too high, then CMHC and the other government insurance companies are not allowed to look at it. So it's not me saying, you can't afford more. It's just that people's income is not sufficient. Maybe their credit's not. So they could find a personal guarantor, or they could. I had a case a week or 2 ago where they were divorced. So we didn't need the separation agreement, but the ex-husband was on the scene in a way. And I said to him, look, if you're willing and able to sign with your ex-wife, because your children are living in the house, then fine. So the lender said, no, the ex-husband's not acceptable. So I said, why? Because they are potentially making up, reconciling, thinking of going back together. And he's going to be living in the house as a primary residence. So we live in a world of big gray, a little bit of white strip and a little black strip on either side. But in the middle is the area of morality, ethics, and expertise in how to advise people to proceed. you know, if they're not finally divorced, they've got to have a separation agreement by law. It's not me being difficult. It's just that the lenders want to know, you know, what's the alimony, what's the child support, what are all the gory details relating to the ability that, let's say, the mother of the children has to make a repayment, because no lender wants to lend money and then the next 2 months there's a default. They don't want that, because they're responsible to their lenders. So there are a number of ways of skinning the cat, but if all this fails, then we have rent to own. So I'll give you a quick 5-minute story on what rent to own can do.
Yeah, it'd be great.
The buyer, our buyer, borrower, will first of all will have to become pre-qualified, just like if he was going to buy a house and close. Why? Because the investor is going to end up buying the property, whether it's a condo or a house, for and on behalf of the borrower. So if they've got all sorts of strikes against them, then the investor is going to refuse, because he doesn't want to have to buy this house. He lives in a beautiful house somewhere or other, and he's buying this house for the tenant buyer occupant, the TBO. So here we go. Now we have a case where I know as a broker, as a mortgage agent, that they can't get their own mortgage. It's not possible. So we go into a rent-to-own case where the most important thing is it's got to be a high annual gross combined income. Let's say a price of about 500,000 to 600,000. I've got to earn about 120 grand or $130,000 a year. Now, what do they end up paying? Once they've chosen the house, the investor buys it. What does the tenant buyer occupant end up paying? They pay 6 different things. Number one is the investor's 80% mortgage, because the investor puts down 20% plus the closing costs. So he's put down about, let's say, a price of 600,000. So he's put down 20% of that is 120 plus another maybe 6,000 or 8,000 closing costs. So number one, the tenant buyer occupant pays the 80% mortgage, the principal and interest. Number two, he pays the property taxes. Number three, he pays the property insurance. Number four, he pays the utilities, obviously, because he's using the lights and water, whatever. And number five, he pays the maintenance, because if the toilet breaks or the air conditioning or the heating, whatever, goes down, it's going to be his house. What does that mean? It means that he can put on a new porch, he can put a new roof, a driveway, a swimming pool. He can improve the value of that property because he's had the investor buy it at, let's say, the 600,000 from the seller. The seller's owned the house for 30 years. Now the investor comes in and he buys the property that's been chosen by the tenant buyer occupant. Now, there's a present purchase price that's 600,000. There's a future purchase price which is escalated by about 3 or 4%, which is nothing. So let's say the future purchase price is 650. That's 3 or 4 years down the line. So the future market price, the actual real value, will be around 700. If we know what's happened, what will happen in the next 4 years based on what's happened in the past, the tenant buyer occupant will be buying that property from the investor at a lot less than the actual market price. I've had 2 TBOs close, buy it from their investor, and they both came out with cash because the market price was so much higher than the future purchase price. And that's an amazing thing. And I don't know why people are so against rent to own. Yes, it's had some bad people do bad things, but we are very conservative in that we don't let anybody go in without the 6th expense, which is the savings component. What is the saving? First of all, there's a deposit of, let's say, 3 or 4%. Now that deposit is given to the investor by the tenant buyer occupant, and it's credited to him in full. That means he owes that much less at the end of the term. Just the same as the savings. Let's say the savings is $500 a month. That is credited as well to the tenant buyer occupant, and it goes towards their total down payment, so that they only need a mortgage of, let's say, 90% of the future purchase price as a maximum, which is really almost guaranteeing them a mortgage, because we don't know what's going to be the law and the stress test and all that stuff in the 3 or 4 years down the line.
So Martin, with when someone has their payments, like, you know how their payments are a lot more during the period they're in the rent to own, does that get split up then? So let's say they owe a certain amount for the down payment. Does that sort of get divvied up, or does that work, that payment?
The full amount of deposit which they paid initially and the full amount of the savings is not divvied up. It's given to the investor as a temporary cash flow, but it's credited to the tenant buyer occupant, and it's his money, so he owes that much less.
Okay, that's a common misconception I thought I'd share, because a lot of people think that their payments are ballooned up and they're way higher. We've seen rent to own where we just had a client in Brantford who had their rent to own after 3 years. They came out on top, and they still ended up, they didn't overpay because that money went towards the house. So that's good. It's good to know.
No, it's very good to know, because it's a motivation, and it eliminates some of the risk, and it's really helping the tenant buyer occupant get a mortgage at that time. Obviously, the value is going up, and obviously their salary or their hourly rates will be going up. Hopefully, they're going to keep the job, because it's not good to job jump during the term, because at the end of the line, when you come to getting a mortgage, the bank will want to have a 3-year job history, and if they see a job jumper changing jobs every year or 18 months, it's counterproductive.
Okay. And so no work employment changes, creative financing in the sense that you have access to lenders that could do a cashback. Rent to own is a second option. So you kind of have this flow chart of, okay, if you're going to be in this area where you're not approved, rent to own could be a good option. In what case would rent to own not be for someone, and when would you advise a client to come back to you later when they get into a better spot?
I just had a case last week where I went to a doctor, and there was a young girl behind, and she got talking about she's trying to struggle to buy a house. I said, yeah, I'm a mortgage agent. I gave her my card. She did not earn enough money. She was in consumer proposal, so I thought it would be ideal for her to go rent to own with her husband, who was a general laborer. But even rent to own, they just didn't earn enough. So, that particular case, I advised them to remain on as tenants. They were paying $1,800 a month, including utilities. And I actually told them to both try and get better jobs, because they were almost on junior entry wages of like $18 an hour.
Okay.
I know things are very expensive in Toronto and all over the world, let alone Toronto, but that's a case where I couldn't help them. And there was no way that they could afford rent to own. And then I said to her, look, maybe you'll find yourself a co-owner. So she went to ask the boss. She works for a company that does colonoscopies. So, I mean, the boss of this medical practice is not going to sign for her. He has no security that, he won't be able to fire her. So there are cases where it's not possible to do anything with people, mainly because of income. Because if they had a better income, even though the credit was low, and they only had, let's say, 3 or 4% down, they could buy on rent to own.
And how does, like you mentioned, consumer proposal, we had a question like this from a client that was going through that. So if you had someone that's going through that situation right now, how does it affect their ability to buy? And do they get access to their credit after, or is it completely
Okay,
something
so
they don't have access
so
to?
with a consumer, with a co-owner, it works like this. Let's assume they don't earn enough. Well, the credit is say 670 or higher, and they've got a down payment of say 5% or a bit more. So they could find a co-owner. It doesn't have to be a relative. It can be just any Joe out in the street. He would come on title and he would earn 50% of the net profit. So let's say
Yeah, like a
600,000.
joint venture partner. Okay.
Yeah, joint venture partner. Price initially 600,000. They're both 50-50 on title. House sells for say 700,000 in 3 years. Less your commission, so that's 70,000. So half of that is 35,000 each. So for 35,000, which is nothing, would go to the co-owner. But in the meantime, the buyer got into the home market. They made 35,000, which they would not have been able to do if they were tenants. So they enjoyed the property price escalations that are always happening in Canada. And the buyer might say, why do I have to give away 50%? I'll say, guess why? Because it's not easy to find a co-owner. Co-owners are prejudicing themselves. First of all, they're at risk, because if the buyer doesn't pay, guess who the bank is going to go to? Is the co-owner. Number one. Number two, the co-owner is prevented from purchasing other properties. Not prevented, but it's more difficult for him to buy other properties now that he is signed for and on behalf of a person. But there are people out there that will take the chance. Again, we need to have a full application to be able to pre-qualify these people and see what's happening with them. So there's lots of ways of helping people. I continue to specialize in challenged buyers. Obviously, they've got to be keen, because a lot of people are referred to me and they don't phone me back and they don't fill out the application form.
Right.
I speak to them, there's no way that they can become home owners. They don't speak English well enough, and there's a lot of communication necessary. It's a sophisticated business list.
Yeah, and I think sometimes we all say either an objection or hesitation is either education, not enough, having enough knowledge on it, or motivation, right? And if it's knowledge, like I see here, I'm looking at 2017 when our home prices had a bit of a change. The market always came back. Like we had 531 in April, May, and then we had a bit of a dip. And then 2019, we started going up, and then 2020, and obviously the rest is history. So I think, like you said, it's important to look at your options and getting into the market. Know that there are options for you, that you can look at maybe a co-owner or someone that could have a benefit of being a joint venture and also receive half the profit.
Sam, a lot of time people ask me, should I buy? Now that interest rates have gone up, they think prices are going down. But the bottom line is that there's a lot of politics and there's a lot of theories out there that some people think prices must come down because interest rates have gone up 4 times in the last 2 months. And my constant advice is a simple thing. You have a family that needs a bigger house, a smaller house, or they've now accumulated credit, down payment, and income. Right now is the time to buy. I don't care what's going on in the market. It's very unusual to advise and to be able to buy in the trough and sell at the peak, because people are not doing with their family an economic game of tennis. They need a house for convenience. So market, that's my advice.
Yeah, it's great advice. We always let clients know, like, I mean, that by the time you think that it hit a valley, it's already back up, and that next valley will be higher than it was before. So,
Right.
I mean, bottom line, as we talked about, immigration hub, moving from more expensive markets. We're still at 1.1 months of inventory, a balanced market 6. So we still have a housing need, and we need to get help people get into the market and see the value of that, because a lot of the people who are upgrading already had got into the market. Like, remember, we helped, I think it was a client, which we won't name, but we helped a client and you helped them with that program. They got in, it wasn't rent to own, but they got in through a different program that you had. And now they've built equity. They've built $80,000-$90,000 of equity.
So
So-
there's a lot of people that are very thankful for my thinking out of the box and always being able to think of something that's legal. I get a lot of people phoning me, oh, I don't earn enough, but I can give you a notice of assessment or a T1 filled in by me. Will you accept? I say, no, I won't. I'm not going to put my what they call my driver's license, which really is on the line, to lose my certification for some idiot that wants to lie. I know there's a lot of that. Maybe there's a lot of it going on, but it's hard enough to be straight and honest and have a good name and have got a lot of referrals and keep a name straight. The worst is the guy has to save a bit more money and time, but it's easier to normally earn more than to save, because how much can they save? Gasoline, food, cell phone, it's all got minimum costs.
Yeah. And like you said too, we talk about this a lot, is having the leverage of getting into the market will, rather than attempting to outsave it, will help them get to their next home, will help them invest, will help them pay for their kids' school. A lot of people are seeing that, with bank costs and cost of living inflation, real estate is a great hedge against that. So are there any common mistakes that people make? Anything that you'd like to leave us with before we wrap it up as well? We're going to put something that people can book a call with you as well if they have questions.
I think a common mistake is often that I give them the green light and they say no. They want to continue renting because they're comfortable in the area. And a lot of people end up having to move to another area, but they start living the new area. They find a doctor, they find a school, they find supermarkets in the new areas. And to remain on as tenants is like a rat on the maze, because they keep paying the mortgage belonging to the investor, and the values go up more than what they could save. They're going up, I don't know, historically take an average of at least 8 or 12% annually, which is a lot of money. So if I'm saying, go back to your realtor, now that I've qualified you at a certain price, 600,000, 800,000, whatever, and don't think of which area are you going to buy in until I've given you a price. The only other thing that we require from realtors like yourself is you send me a copy of the MLS or 3 different MLSs that the buyer can choose from. And then once we know what the property taxes are and the heat and if it's a condo, the condo fee, then we know, because there's really no such thing as a real pre-approval without knowing a particular property, like I call it, have you got a peg to hang your hat on?
Yeah, actual property to the taxes, the fees, what's included. Is it commercial? Is it resident? There's a lot of things we got to approve the property.
And then once they choose a condo, I always make it my business to phone the condo corp and see if that building is healthy, because some buildings are sick. They're not healthy enough, and you cannot get a mortgage at any price for those, because they owe property tax, or the managers are stealing money. I call an electrician for $200 and they say it's $300, and all sorts of things are happening which makes a building worth a lot less. If they were honest, each condo would go up a lot in value. Why? Because the condo fee would come down. And some buildings have got very high condo fees because of this stealing thing.
I think it's really important when you have like as well a realtor that's working for your best interest, to understand the condo corp, to make sure that they're in contact with the right people to analyze the health of that condo financially, and as well assessments and other things legally that could affect the sale, the lenders getting funding for the deal as well. So I think that's a great point, Martin.
I live in a beautiful condo in Thornhill, and we have a very good, honest, experienced managing agent. And whenever I see a building in trouble, I push my managing agents onto that building to take over and pull it up by its bootstraps to stop the stealing and stop the bleeding and get that building back into a healthy state, because everybody is hurt when there's one or two people on the board that are dishonest. So these are the practical dimensions of life in Canada.
Yeah.
And we have to be aware of them, because it's no use having a qualified buyer fall in love with a place and you cannot get a mortgage on that building.
Yeah, I appreciate that very much, Martin. I mean, it's been really helpful. A lot of good information about creative financing and things like that. And some information I think that was really tactical for people. Where can people reach out to you? What could they do next if they're
They
not
can
sure?
phone me at any time on my cell phone is 416-524-5518. They can look me up under one of my sites is magicalmortgages.ca. Another one is home to own H2O for water, home to own H2O.com. I work from home in Thornhill. I have offices in Markham if anybody wants to meet me and talk to me, but I end up meeting very few people because of Zoom and because of the fact they have to fill in the application. And you know, if I were to meet them, I'll say, okay, what's your name? What's your SIN number? What's your phone number? You've got to fill it in anyway.
Yeah.
But I'm more than happy to help,
Right.
you know, if they want to.
Okay, we'll make sure that everybody, if they do book a call with you, can definitely use the code word affluence. We'll make sure that you have our concierge are connected with everything that you need. Martin's going to help you as well if you're looking to get into the market, or you've been looking to get in the market and you need a good reason, and maybe potentially see if that's something that you can realize homeownership. So Martin, thanks for coming on. Got a lot of value, and we'll make sure that we keep in touch.
I always believe in talking first to the buyer to get a feel, to build a chemistry, a friendship, to understand their story, because emailing can take hours and hours and you still don't get the correct feeling. But a 5-minute chat is very valuable for me to understand how best I can help them.
That's
Very
awesome.
nice, Sam. Thank you for
Thank you
inviting
so
me.
much, Martin. Really appreciate it. And we'll make sure we have your contact info.
Okay, lovely.
Have a great day.
Happy selling.
Happy. You take care. Thanks, Martin.